Today, we're diving into a huge change in how our economy works, especially when it comes to financial bubbles. We've gone from these kind of specific manias, like for tulips, to something that feels like, well, a bubble in everything all at once.
Have you ever noticed this? You check your portfolio one day and it's a sea of green, everything's up. And then the next day, it feels like everything, your tech stocks, your crypto, you even hear about the housing market, is flashing red. Well, you're not imagining it. And we're going to figure out exactly why that's happening. And really, that's the core of what we're talking about today. It's like the rule book for how financial bubbles work got completely thrown out. We've moved away from these isolated frenzies in just one thing to this brand new world where it feels like everything inflates and deflates at the exact same time.
So here's how we're going to break this down. First, we'll look at how bubbles used to work in what we'll call the era of specificity. Then we'll get into this modern everything bubble, put the two side by side to really see what's changed, and finally, we'll look at the biggest risk this new world creates, something called the Great Synchronization.
All right, so let's rewind the clock a bit. For centuries, financial bubbles were, well, specific. They were focused. And that focus was super important because it meant that if one corner of the market was going crazy, you could always find a safe place to hide your money somewhere else.
I mean, just think about the famous bubbles from your history class, right? Tulip Mania was literally about tulips. The South Sea bubble, all about one company's stock. And even more recently, like the dot-com bubble or the 2008 crisis, the craze was centered on very specific assets, internet stocks or housing. They were absolutely massive, for sure, but they were also contained.
The dot-com bubble is really the perfect example of this old way of doing things. All the hype, all the money, and, the eventual crash. It was all laser-focused on this one new world-changing idea, the internet.
And this chart, this shows you exactly what I'm talking about. Look over on the left. Tech stocks got absolutely crushed, down 80%. I mean, devastating if you were all in on tech. But now look to the right. While that fire was raging, other assets were totally fine. Value stocks were up. Real estate was up. The fire was in one room, not the whole house. There were places you could go to be safe.
But that, of course, brings us to today. And the game has completely changed. We're not talking about isolated fires anymore. Now, it's more like the entire ocean is rising at once. And that, my friends, is a very, very different situation.
So what is the everything bubble? Well, here's the key difference. It's not driven by some exciting story about a new technology. No, it's driven by liquidity, which is just a fancy way of saying the sheer amount of cash that's sloshing around the financial system. And that cash, it doesn't care about a story. It just lifts all the boats. Stocks, crypto, real estate, you name it. This little flowchart shows the chain reaction perfectly. It all kicks off when central banks pump tons of money into the system, usually after a crisis like in 2008 or during the pandemic. This pushes interest rates way down, close to zero. And when that happens, holding cash suddenly feels like you're losing money every single day. So this cash is trash idea takes over. Investors feel like they have no choice but to buy something, anything, that might give them a return. And what's the result? Everything inflates together.
Okay, so let's put these two eras right next to each other. The old world of specific bubbles versus this new everything economy. The comparison is pretty shocking, and it explains so much about the wild financial world we're all living in right now. This right here, this slide gets to the absolute heart of it. The dot-com bubble was driven by a story, a narrative about the future. The internet is going to change the world. But the everything bubble, it's driven by cold, hard math. With interest rates at zero, there is no alternative, what they call TINA, to investing in riskier stuff. It's a bubble born out of what feels like necessity, not just a good story. And this table just lays it all out. The primary driver, it went from a narrative to just liquidity. Asset correlation. Used to be low, now it's super high. The psychology is totally different, from this new tech is the future to just cash is trash. And this is so important. Look at the safe havens. They've basically disappeared. And how do these bubbles pop? It's not one sector failing anymore. It's the central banks themselves deciding to turn off the money printer.
So what's the real consequence of all this? Where does this all lead? Well, it leads to what we can call the Great Synchronization, a brand new kind of risk that is totally different from what investors have dealt with in the past. This quote just nails it. The biggest risk today isn't that one of your investments will go down, it's that all of them could go down at the same time. When everything moves in lockstep like that, a correlation of one,
The old rules about diversification, you can pretty much just toss them out the window.
And here's a perfect real-world example of how this can bite you. You've heard of the classic safe 60-40 portfolio, right? 60% stocks, 40% bonds. The whole idea is that when stocks zig, bonds zag, protecting you. But in this new world, when central banks have to hike rates to fight inflation, it sets off a domino effect. Bond prices fall. Higher rates hammer stock valuations, and they make real estate way less affordable. All of a sudden, everything, stocks, bonds, housing, it's all falling at once. That correlation gets dangerously close to 1. So this brings us to a massive shift in how you have to think about investing. The old playbook was all about rotation, sell what's hot and move into what's safe. But the new playbook? When the big storm hits, it might just be to hide. In a system-wide crash, cash might be the only real place to take cover.
But that leaves us with one last kind of mind-bending question. If the big risk of our time is that everything falls together, could the big opportunity be that everything gets cheap together? Could a synchronized crash actually create a synchronized, once-in-a-generation buying opportunity across the board? It's definitely something to think about. Thanks for watching.